Are you a self-storage owner or operator looking for service providers to help at your facility? Well, the Storage Business Owners Alliance, also known as the SBOA, has you covered. The SBOA is a premier online hub for connecting self-storage owners and operators to industry-leading products and service providers. We provide one-stop shopping for your business with exclusive offers to save time and money. At the SBOA, we believe by coming together, we help owners and operators grow revenue, gain purchasing power, reduce expenses, improve efficiencies, and increase profitability. We also offer many resources such as our conferences and self-storage unlock webinars to help self-storage owners and operators gain the knowledge needed to become more competitive in the industry. To become an SBOA member or to find out more information, please visit www.thesboa.com today. We can't wait for you to join the Alliance.
Good morning, everyone, and happy Thursday. Welcome to another edition of the SBOA's Self-Storage Unlocked. Today, we are going to be talking all about the changes that we are seeing in the lending environment for self-storage. For those of you that don't know me, my name is Jessica Johnson. I'm the Vice President of the SBOA. We're so happy to have you here. We do these educational events 2 to 3 times a month, typically, where we spend 1 hour with industry experts that we bring together to talk about all different types of topics. And we could not put on these type of events without our partners. So huge shout out to Sauls Storage Group, Live Oak Bank, and the BCS Group that are here with us today. Very excited to have all these speakers with us today. They are they have loads of information and knowledge for you that I can't wait for you to learn as we talk and discuss financing today. So a couple quick housekeeping items. If you have questions or comments for us, I see most of you are chatting already in the comment section. That's how you can engage with us. We like engagement. We want to hear from you. We want to answer your questions. So please, while we have the panelists here today with us, ask those questions. And we do ask some poll questions throughout today's event. So if you see a poll question pop up on screen, please put your answer to the poll question in the comment section. But I'm going to go ahead and get us started. And I'm going to bring up our first speaker, who is Adam Karnes from the BSC Group. Hey, Adam.
That's how are you?
Good. How are you doing?
Oh, I'm doing well. You like my new remodeled house behind me?
I do. It's fancy. I love the grand piano in the back. Are you going to play us a tune?
Not me. But yeah, excited to be here.
Awesome. Well, Adam, tell us about you and the BSC Group.
Sure. So BSC Group, we're a mortgage brokerage firm focused on self-storage. We do other things sometimes, but it's been mostly storage since Sean and Devin opened up in 2009. I'm a broker for the BSC Group. I was a longtime analyst there, so got a lot of credit training in storage. And for the last 3.5 years, I've been brokering deals. And we are based out of Chicago. And yeah, so we're excited to be here. This is a really fun topic to talk about, and one I get a lot of questions about. So
I'm sure you do. It's a challenging topic these days, but one worth discussion. So thanks for being here with us today, Adam. I appreciate it. Awesome. Next up, I have Anna Taylor from Live Oak Bank. Hey, Anna.
Hey, Jess. How are you?
I'm good. How are you doing?
Doing great.
Awesome.
Thanks for having me.
Yes, thanks for being here. You are like the lender with all the information. So we need the information because you guys have a self-storage specific division. So tell me about that over at Live Oak Bank.
Yeah, we do. So we've got a team of dedicated lenders, underwriters, closers, you name it, at Live Oak Bank. We put the group together in 2015. I've been with the team since inception, and we've done over $1 billion in self-storage financing to owner-operators, buying, building, expanding kind of their self-storage empire. So happy to be here.
Awesome. Sorry for that in the background. Thanks for being here, Anna. I appreciate it. And last but certainly not least, I have Jane Sauls from Sauls Storage Group. Jane, you are on mute. Make sure you hit that unmute button real quick before you start talking.
Good call.
There you are. Good morning, Jane.
Good morning. So
Jane,
happy to be here.
Yeah, we're happy to have you. So Jane you're a broker and you're very involved with GASA. Tell me about the brokerage and GASA and what you do.
So I'm a real estate broker. We focus in the Southeast on the self-storage product. So that's what we do day in, day out. We are very active with many or most of the state associations, all that we can be. That's where we feel programs like this and the state associations just bring a huge amount of value. I'm excited to hear what Adam and Anna has to say. I know that they're going to bring magic that I can go back and deliver to owners and investors. So,
Sure.
So yeah, and I have a development and operations and project management background as well in the self-storage industry. So been doing it for just a minute.
That's awesome. Well, we love having you with us here today, Jane. So I'm going to bring everybody back up and we're just going to dive in. And again, audience, if you have questions for the speakers as we go through this, please ask them. This is a pretty important topic. So I wanted to play, what's the Pink Floyd song? Money, 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 or Money. But as we started this, because everybody's out there trying to figure out where they're going to get this money, right? So obviously we've had a lot of economic changes within this, last several months. So what are you seeing with economic changes that are influencing the demand for actual self-storage units, and then how that subsequently will influence the lending practices? Anna, I'll start with you. Sorry.
Yeah, so if we're talking about demand for self-storage specifically, I think a lot of people get hung up on kind of national data. So there was a Wall Street Journal article where it was like doom and gloom, storage rents are falling. And then the next week there was an about face in the Wall Street Journal saying there's never been more demand for self-storage, So I think what you need to remember is that the storage industry is not something that you can kind of extrapolate national averages to your specific market. It's hyper location specific. You're probably only going to be drawing customers between a 3 and 5 mile radius. So I think what's most important is what's happening kind of around you. So I think, you can look at the macroeconomic data. I still think it's pretty positive. I read the REITs quarterly reports, their earning reports every quarter, and they're seeing rental rates at their facilities up pretty much between 9 and 11%. Across the board. But I think it's most important to focus on where you're kind of looking to invest in your specific market, and kind of what the rates are doing there, what the occupancy is like there.
Yeah, and I would agree with that comment on the super localized. I get that all the time on the marketing. They're like, what should my marketing be? Well, that's a really blanketed question, Where are you located? What's going on within that 3-5 mile radius? What's happening? So yeah, I would definitely say that I would echo that. Now, Jane, are you seeing, because you're on the brokerage side, so you probably had a lot of stock a couple years ago out there to service and sell to people, and I'm sure that inventory has gone down significantly. So talk to me about that a little bit.
Yeah, so if we go back to thinking like 2019-ish, we've seen the product on the market wasn't in the primary markets, right? Most of the available product was more out in that secondary and tertiary market. And so that had already created some interest in those markets. And then with the peak in valuations, everybody who would have been a seller for the next 3 to 5 years probably jumped on that bandwagon and sold. So we've got a couple of things going on now as far as the inventory is concerned. You'll hear some say it's all 50 to even 80% of what they're used to seeing. But if we think that through, it kind of makes sense, right? Because if everybody that was a seller for the next 3 to 5 years just sold in like 2 years, from the natural perspective, we don't have anybody or as many people even supposed to be selling right now. Because we pulled them all in that area. And then you've got everything else that we're going to talk about today that's going to speak to that as well. Yeah. We have a huge gap as everybody knows, between the buyer and the seller expectations now.
Oh, big time. Probably one of the largest gaps I think we might have ever seen so far. We gotta definitely decrease that gap for sure. So be realistic in these deals and transactions too, right? I think we get some unrealistic measurements out there just because everybody's been riding that high wave. And I think people that came in during COVID and really don't know the industry other than that, time period, it's starting to level out and come back to normal. Like people that have been around, we're not panicking. The people that haven't been around are starting to panic and they're going like, what am I doing here? So Adam, this one's for you. How about regulatory changes and how that is affecting underwriting criteria and documentation requirements as it relates to self-storage lending?
Sure. So I think one of the biggest changes we've seen, and it makes sense, is as rates are going up, and as the agencies that regulate banks and the auditors that regulate banks, can come down with a pretty heavy hand. Some of the changes to, for example, if a lender used to be able to offer non-recourse below a certain leverage point, that's tightened up. Leverage just in general. So that is a factor of higher rates means lower debt service coverage ratio, holding your net operating income equal. So where you might have been able to in the really rapidly rising rental rate, not interest rate environment, it might have been something where you could be a 120 debt service coverage ratio and get, permanent debt all day long, or 125. And now some of those lenders are stressing with higher rates. So it might be underwritten to a higher rate than you ultimately end up with, but because there's so much uncertainty. And then some of the changes like, requiring deposits, that's a huge one. That was not in the time I've been working doing this. That was not a huge concern, was putting down 5 or 10% of the loan amount in deposits with a local bank, regional bank. That's been one that's met with some scrutiny from the borrowers. And then another thing that's become more relevant recently is with floating rate debt. So if you have floating rate debt, and as we've seen in the last 18 months, that those rates have gone up pretty drastically if you're floating. So the implementation of cap requirements, so buying some kind of hedge against your rate going up, is definitely something that's wasn't on everybody's radar a couple of years ago when, like as Anna and I were talking about a few minutes ago, when prime was at 3.25 and it felt like it stayed there forever. People weren't as concerned about buying rate caps, but then all of a sudden now it's at 8.5. So those are pieces that are required. I'm trying to think if there's anything else that comes to mind.
So you're seeing more people buy that rate cap right now, Adam?
Especially in, floating rate debt, bridge debt, that sort of thing. We're seeing lenders basically require it. Doesn't have to be purchased through the bank, but a lot of times requiring a hedge against rates going higher. Now, hopefully we're reaching the peak, we're getting there, and hopefully rates will reverse. But yeah, we're seeing that now, not on fixed rate debt. You don't have to, buy a cap on fixed rate debt, that sort of thing. But that was a big change in the bridge market. And floating rate debt was just having to buy interest rate hedges so that, you could sort of plan for a fixed coupon and not be exposed to if rates go up 3% in the time that you're floating and all of a sudden the project kind of falls apart because you can't service your debt.
Sure. Yeah, definitely. Now, Anna, you had said that you guys over at Live Oak haven't really changed your underwriting requirements, right? Talk to me about that.
Yeah. So I think what's important is you got to figure out what are the characteristics of a project that you like. And so for us, like a big one is debt service coverage. So that hasn't changed. It's just harder to hit with interest rates being higher. And so, customers are going to have to potentially put more money down. But I think one thing that's helped us as well is, focusing on the projections. We've got a large portfolio of self-storage loans. We see what happens when a sharp operator goes into a mismanaged facility and turns things around. So I think a lot of it is getting comfortable underwriting off of projections, but digging into those projections to make sure that they are reasonable and they make sense.
Yeah, that makes sense too. What about, the general trend in interest rates for the self-storage loans over the past few years? I mean, what does that look like and how has that affected what you've seen in customer behavior with lending?
Well, I would say, I mean, interest rates over the last 18 months, 2 years, I mean, it's been pretty much a J curve, straight up. You know, the Fed is really trying to get on top of inflation. And so their kind of lever that they can pull has been increasing interest rates. To Adam's point, I agree. I think we are at the top, if not very near to the top. So I do think we're going to see, if the economy continues to respond in a positive way and we're meeting those inflation targets quarter after quarter, I think we'll hold for a little bit, and then I think we'll see it kind of relax. Are we going to go back to rock bottom rates that we saw during the pandemic? Probably not. But are we going to be stuck up here forever? No. And I do think that we're at the top right now, according to all the kind of the feedback that I've been seeing from the Fed.
Yeah, my mom always, this has to do with housing loans, always likes to remind me that when they made a house purchase, I guess in like the early 90s, their interest rate was like, I don't know, 13 or 14%. And she's like, and you're complaining about 3.25%? And I'm like, yeah, you know, so times are definitely changing, and they change rapidly.
Jess, can I just make one comment on that last question?
If you had anything on that,
Yeah, Anna made a great point. And I think one other thing we've seen is not necessarily the choice of the borrowers. They don't always love this, but kind of like I was saying before, having to adjust expectations of what is reasonable for leverage. So, you know, where you could get 75% a couple of years ago, 70%, now it's 60, 65% in conventional rates. But one of the things that's great about the SBA, which is, you know, you can kind of forecast, because as Anna said, they haven't really changed the metrics that they need to hit for the loan at year 1, year 2. And I can never remember exactly what they are, but I'll call Anna or Bashash and I'll ask, and I'll say, hey, if I'm looking at this project and I'm trying to understand, is it a fit for the SBA? You know, unlike some of the other lenders that we work with that are, you know, have different standards depending on who they are, what kind of property or what kind of lender they are, with the SBA and with the certain programs they have, I can go, okay, this is what this looks like at the end of year 1. This is what it looks like at the end of year 2. Are we meeting the steps that they're at? And you can kind of get to, you know, they'll make some adjustments after I do my underwriting, but I can kind of go, okay, this probably makes sense to take to the SBA. And that is a great, you know, in addition to the higher leverage you can get in the SBA, but that is one thing I love about trying to underwrite a deal and seeing if it fits in that bucket. I don't have to make, you know, 20 calls to see what every different lender is, you know, thinking of for a stip on the debt service coverage ratio down the road. So that's my 2 cents on that one.
Yeah. Go ahead, Jane. Yeah.
To that, we're also encouraging the investors to be sure they're stress testing those rental rates. Whereas we were continuously bumping, even if it was little bumps or big bumps, we were growing those rental rates. I'm sorry, I think I just said stress test the rental rates on their pro forma to see if their math is still going to work, because we're seeing lots of markets, you know, pull back on that street rate. And so they've got to be able to survive and compete against those facilities that are doing that.
Yeah, absolutely. Now, Jane, tell me, because you're on the brokerage side, tell me from your perspective what you see as the biggest challenge right now for a buyer and for a seller.
Oh, the biggest challenge is their expectations both ways. Yesterday, an investor was like looking at a conversion with me, and I was like, it doesn't work. And he's like, but I can't build this building for what they want for it. Like, I can't build this building. And you're telling me, and I'm like, that is correct. Like, just because you can get in a property that is for less than construction cost of that building, or what may seem to be a good deal for what you perceived in that market, doesn't mean the rental rates are going to justify that investment. Mm-hmm. And then on the sell side, I'd say we have on the seller side, we may have a little bit of a more greedy mentality going on in our
value is higher than it is.
So, the owners have to keep in mind, I believe, that right now, over the past several years, yes, they've enjoyed increase in valuations, but truly, we as owner operators didn't do anything to deserve that. And you may have kept your facility clean and amazing, and you may have been pushing your rates, but we were in the right place at the right time. And so now, from the owner's perspective, they're getting a little bit of a wake-up call, because they're going to have to get back and see who's good at what we're doing. Because now it's it's real business. Nothing's going to be handed to you. You're going to have to, where should I market? Where should I do this? What should my rates be? People aren't just filing in, and, we have slower to pay folks. We see that coming on board. So just the whole adjustment phase, I suppose.
Yeah, I mean, with the changes in it, the economy with inflation just in gas, groceries, food, and all that, I mean, disposable income is not what it was there, so people probably are starting to default. I do believe that I've heard that delinquencies are starting to creep up a little bit more than they had been, over the past couple months or whatever. So so have realistic expectations. I do want to circle back to the point Anna made about listening in on the quarterly REIT calls. I would highly suggest that any owner operator, no matter what level you're at, don't think because you're a small guy, you can't listen into a REIT call and it have relevancy to you, because it can. And if anything, it's going to teach you some really good metrics and KPIs that they see and that you could try to emulate throughout your growth, of your portfolio, hopefully. So how about some innovative financing options? Are we getting into some creative structures over here to make, deals work? What's happening? Are we selling off children to, our firstborn child to get a facility? What are we doing over here? Anna, I'll start with you. I'm going to keep calling you. I'm so sorry.
No, it's all good. All good. I'm used to it. So I would say one thing that that we can do, because we're, at Live Oak, we're on your side. If we can figure out a way to make it work, we want to make it work. So I think on a lot of acquisitions, we will collect the seller's historical financial information and take a look at how that looks like. But if you have projections and they're reasonable, where you're saying hey, look, pretty much everything in this market is rental rates at this level, and this seller is 30% below, or this seller is employing his son and paying him $50,000 a year to manage this facility, and we really don't need that. Those are reasonable. If you say you're going to quadruple NOI overnight and operate at a 90% margin, that's where I say, hey, I'm not going to accept those. But I think being able to work with a lender who can see the potential in the property with you is important. If you have a lender that's just going to underwrite off of historical financials, it's going to make it really tough to get anything to pencil, no matter the leverage point there. But I think one thing that we're also doing to help kind of take the sting out of the rates being what they are right now is we're doing interest only periods, even, a year, 18 months for an acquisition, just to help you kind of make those operational changes, improve the performance of the facility before those P&I payments kick in. And we can also finance working capital that you can just use for operational expenses or making those first couple of payments, or even maybe doing some upgrades to the facility, adding a fence, adding better lighting or better cameras. So that way, when you kind of increase your rental rates to your tenants, there's a reason why you're providing a better product and a more reliable, safer facility for them.
Jess,
I saw.
Go ahead. Sorry.
No, I saw a comment on one of the Facebook forums the other day, and it was should we 3x our rent within the first 6 months of a new tenant? I was I don't know about 3x in it, because they're going to leave real quick, So it's wild what you see going on out there and things that they're saying. Go ahead, Adam. I know you had a comment.
Yeah, I was just going to add a couple things we've been seeing. So, a couple of years ago, the bridge market, which we call the bridge market, anything where, you're transitioning from, an asset that has a story, an asset that's in lease up, there's some transition taking over ownership, something like that. So that market used to be super lucrative in terms of the interest rates were right in line with where, permanent debt was. So now if your best rate you can get in permanent financing is somewhere in the, call it low sixes, and the bridge market is sort of way out of whack, way higher rates than that. And the spread between where permanent and bridges has widened out so much. So one of the innovative things that we've done, which has actually worked well, I just closed a deal where we did this a couple of weeks ago, is utilizing a lender, a product type in the lending world that has flexible prepayment penalty. So if we go out and get a credit union loan, for example, and there's a prepayment penalty in year one and then it's open, or the deal we just closed, actually 2 deals I just closed with credit unions have no prepayment penalty at all. So if you're able to do that and you're able to take advantage of lower interest rates, now the product has to still meet some debt service coverage hurdles, but what it can allow you to do is bridge. So if you're leasing up, if you're not fully stabilized, but you cash flow enough that you can, service your debt, and you're expecting that rates are going to come down, you can put that loan in place now and then refinance in a couple of years. Where, like we talked about, I don't know if this was offline or online, but talked about CMBS. CMBS has really strict prepayment penalties. So if you do a loan in CMBS, you're sort of locked in for a while. Whereas if you do something where you can get out of that, refinance in 2 years, that's a great hedge against, okay, well, if interest rates go up more, I can stay in this product for 5 years. But if they come down, I can refinance and take advantage of that. And then sort of in line with what Anna was saying, but to a lesser extent, this is something I think the SBA is really exceptional at. And it's a way that people can get involved and buy properties in a way that works. But some of the credit unions we work with will do deferring debt service coverage ratio tests for a year. So not necessarily underwriting on projections like Anna was saying, but giving some credit to, okay, we see that this product's going to get there. We see that this loan is deeply below market in terms of rents. It's being operated crazy now with the existing owner, but when our person takes over, they're going to put new management in, change some things, and really lease it up quickly. So then coupling that with interest only, deferring some of those debt service coverage, steps, that can really help in this market where rates are such a wild piece of the equation. So that's something that I wanted to just mention, because it's not something that we thought of by any means, but it's something that has worked well and sort of fallen in place pretty good for people that otherwise used to use bridge debt, and bridge debt is super expensive right now. So that's one I wanted to cover.
Awesome. This one's for you, Anna. This is specific to Live Oak. Why is the minimum loan size for SBA $500,000 to finance for self-storage with Live Oak Bank?
Yeah, that's a great question. We set a minimum loan amount just because it takes about the same amount of work to process a loan, regardless of size, within reason. And so just kind of figuring out what works for us and for our team, we kind of put $500,000 as the minimum loan amount. As it gets if we go below that, it's just hard for it to make financial sense for us to dedicate our team to it. So we kind of set that there. Luckily, I would say our average loan size is probably between 2.5 and 3 million. So we're seeing more of the larger requests anyways, but it does weed out some of the people that are looking for higher leverage on a smaller facility. And so that's just our personal policy. You can get a small business loan below 500,000. Just find a bank that kind of offers that program and is interested in the property.
I can help.
And Adam can help. And that threshold used to be lower a few years ago, right?
Yeah.
Wasn't it 350?
It was 350. It was 350, and we made the decision, I think, probably 2 years ago to bump it up to 5.
Yeah, it makes total sense why you guys did, for sure. Now, Jane, this one's for you. Of the successful property closings of 2023, what is the approximate split of how buyers are funding the deal? Traditional financing, all cash, partial seller carry? Of the properties under contract that have fallen through, what position is financing the deal breaker versus other reasons for deals falling through? Ooh, that's a long. How do we unpack that? Let's go for the first part. 1, 2, or 3, Jane.
Okay, so the best one, I think, for closing deals with the gap in the expectations, and that is when the seller won't let go of that pie in the sky number. And the investor will pay that if the seller will actually finance it at 1.5 years ago's interest rates. And so that has worked. And so you just got to get creative. You definitely, in generally speaking, you're going to have to put more cash in the deal to make your numbers work. And it's also where we're positioning ourselves. You got to think not just in getting the deal done. You've got to think about leveraging yourself and positioning yourself for success. So being able to put more cash in the deal definitely is almost a no-brainer at this point to actually have to meet that gap. And then the seller being willing to take back a second on it is usually there's some pushback on that. If he's going to do some financing, he wants to stay front and center, generally speaking.
Sure. Now, on
the other questions.
Well, yeah, the other half of it basically is if out of all your deals, is the main reason it falling through due to financing, or are there other reasons that have come up that are very prominent, I would say?
Okay, so definitely as the interest rates are going up, because nobody could get their due diligence done in a rate under the same interest rates going on. So yes, interest rates increasing definitely killed numerous deals.
Mm-hmm.
And then what else was there?
Just, are there any other, like, would you say there's any, like, do you see a theme in anything outside of financing making the deal fall through that has happened with any of your clients?
The interest rates going up, that killed the deals that was going on. And then now we have the hesitancy of investors even trying to do a deal because, as they put it, they don't know how to pencil it. And so most of the investors are sitting there with the cash ready to move, and we've not seen them truly move much in the last, 9 months or so, because they're not comfortable in what they're penciling. So the interesting part, I think, will be seeing if those private equity groups actually come to the table the last half of the year, because they are holding a lot of cash that they need to do something with. And so seeing if the sellers are going to actually become a little bit more realistic in their expectations, and then, the buyers become a little more eager in being able to satisfy what they promised to their investor groups.
Jane,
Yeah. Go ahead, Adam.
I don't mean to jump in, but I just was going to make a point that I think is interesting that I'm sure Jane probably sees, but you have this like chicken or the egg kind of feedback loop thing where deals that fell through for us last year fell through because, it was at a certain purchase price. Let's say it was $2 million and the loan was whatever it was. And so then as rates were going up, the underwriting got tighter and the lender said, hey, we actually think you're overpaying for this. We think that, our rate, which we couldn't fix beforehand, has gone up now 45 basis points, 50 basis points. And for those of you new to that concept, so 50 basis points, half a percentage point. So then they go, well, we have to cut proceeds. And so then the way to make the deal work is say, well, okay, we got to go talk to the seller, because while interest rates don't necessarily one for one affect your purchase price, well, that means that your borrowing prices, your yields are going up. So then, okay, can you lower your purchase price from 2 million to 1.9 million? Well, the seller says, no, I think I can get 2 million. And then if that deal falls through and Jane has to go take your deal back out to market it, there's not really a sure thing that she's going to be able to go out and get you 2 million again, because if rates keep going up, the amount that people can get financed, sort of what she was saying, the amount that people can get financed comes down. So then all of a sudden Jane's going, hey, shoot, maybe we should have taken that first person asking us for a slight reduction, because now, the number is much lower. And I don't want to put words in your mouth, but that's what we see on the mortgage brokerage side is there's this feedback loop. Unless you're able to get the deal underwritten and lock rate ahead of your closing, there's so many products that don't allow for that. And so in the 60 days that something happens, more so than ever in the time I've been doing this, rates are moving. Rates being the same 60 days later is absolutely not a given. And in fact, I would be very shocked if any deal done within the last 18 months, the rate when they started, outside of something that, they were able to fix ahead of time, the rate that they started at was where they closed. So we've seen, exactly like Jane's saying, we've seen a lot of those, things can't pencil. And that speaks to, people doing, I think one of the first questions you asked about changing borrower behavior, it's like, well, if they're getting from every angle someone telling them that this deal won't work at a certain level and they have to stress their interest rate, they're going, is this a good idea? But there are still deals out there that make sense. That's not to sound all doom and gloom, but it's just a matter of meeting seller and buyer expectations, which there seems to be a pretty good gap between still.
Can I jump in on that too?
Yeah, go ahead.
Because I do think, and this is something that I've seen personally, is that you have to look at kind of every challenge on the other side. There's kind of an opportunity there, right? So I think about, if you're looking to buy, and I'm sure a lot of people on this call are looking to acquire a facility, and interest rates being the highest they've been in 22 years, yeah, that's a bummer. That's going to make it more challenging. But if you think about it on the flip side, there's a lot of people that are sitting on the bench waiting for rates to come down. So like me personally, I've been lending since 2015. I wanted to buy a facility in 2021 because I was like, I'm sick of watching other people make money on this. I gotta get in there. And so it was 2021 and we were going up it was like, just call for offers. The listings weren't even hitting the market. Things were going for millions above ask. And it was really, really tough. But we kept out there, and then we found something at the end of 2022. And I think, interest rates had gone up, but I think, part of the reason that we got that property is there wasn't as many people fighting over the same property as a year before when money was a lot cheaper. So if you think about it that way, if you can make a plan to get a facility under contract, you're probably going to be competing against less people. So there is an opportunity there. And I think Adam said this, but if you can find something that works now, that's a really good sign. Because if you think, kind of get out your crystal ball, if you feel like interest rates are going to be falling in the next 12 to 18 months and you can get it to pencil now when rates are high, that's a really good investment for you. So things that were, that penciled in 2018 when interest rates were super low, it's not going to be kind of the same. But if you can find a good opportunity, I think it's worth chasing. So I think just kind of giving up and waiting until rates come down, you can do that, but there's probably 20 other people, looking in the same area as you that are doing the exact same thing. So I say keep out there, look for good properties, work with good people to find something.
Well, and if I hear this one more time, I might pull my hair out. It's like, we want a value add property. Well, get in that. Everyone wants a value add property. I mean,
Let
it's
me
like
write that down.
Yeah, it's the coin term, right? And I get why that's how so the SBOA partners, we have a different division where we still own properties now, but we had a really big portfolio. But the way we did that was through acquisitions, back in the day. And we were just aggressive with it, but they were with value added properties back then. I mean, that's just harder and harder to find these days. And Adam, you've worked with that group. They raise equity to deploy. They're taking a very different approach these days. They raised 13 million in like a week and a half. Now they've got investors that run deep with them because they've been working with the same investor pool and making these investors a lot of money year over year. So they're like very anxious for us to do stuff. So raising 13 million in a week and a half is pretty much unheard of for most people, right? But we did it, but we paid cash. They paid cash on the deals, right? And Adam, I mean, back in the day working with, the partners over at SPM, like, would you have seen them doing cash deals back then? Probably not,
No, yeah, that's been another shift. That goes back to another question that was asked earlier, just the shift in, how people are getting deals done. Because when money is cheap, I don't know if it's Warren Buffett or whoever says it, you should use other people's money when you can. So when rates were 3%, there is no question that it makes sense to finance a deal. And that's not to say it doesn't make sense to finance a deal today. And actually, I see some questions in the comments here that I was gonna address.
We're gonna get them up here.
Those are really good questions. But what I was going to say is, it certainly becomes more challenging when your rates are double and then some that they were 18 months ago. But like Anna said, like we were sort of talking about, if you're one of those people, and I happen to be one of those people, I don't know exactly when, but if you're one of those people who thinks that we're sort of at the top, we could go higher for sure. There could be something that happens where we go higher on interest rates. But if you're someone who thinks we're going to be, moving down, and maybe you want to ride a floating rate down, if your deal works now, that's a good sign, because it was easy to make deals work when rates were 3%. And that isn't to say there was some cushion, right? There was definitely cushion in those deals. It wasn't like they just worked. They just barely worked. There was the debt service coverage ratios were through the roof, and all that. So now that's tightened up. But then there's some good questions in here, because I wanted to talk to, I think Travis asked a good question, and so did Brian. So
yeah, I'll definitely pull those up. But yeah, just to go back to that, it's a strategic move. It gives leverage. You can walk in and be like, your property's 4 million. Here's 4 million cash. Not a lot of people are able to walk in and say that. So that's, I would say, more of an anomaly, but not necessarily, because there are investment groups out there that have that kind of buying power behind them too, and that type of equity to deploy. So I'm going to start with Brian's question first. This is back on construction loans. How are things looking for construction loans for new development, regular or boat/RV?
I can take that one. We do a lot of development financing, and I would say the demand is still there. It really depends market over market. So if you are in a good market that has a lot of pent up demand and strong rental rates, that's a good place to develop. I think the things to look out for would be looking at your kind of rental rates. Are you seeing, those coming down? Are you seeing other properties in the permitting and approval process pipeline? Because if you think about it, if you're in your market and it's all mom and pop facilities and they're full, they're probably not going to be your direct competitors. What you really want to avoid is coming out of the ground with similar product at the same time and competing with another new facility. So we require feasibility studies on any new development that we do. And I think it's really important just for the check to see kind of what's on the radar. Are there properties in the permitting pipeline? Are there properties that are in the kind of rezoning pipeline that could be a potential competitor there? And then we also like underwriting off of those projections because they are super conservative. And it's pretty amazing to me. We finance so many construction projects, and our servicing team will measure once the facility is built, they'll measure the performance off the feasibility study. And it's amazing how accurate those studies can be. I would say it's kind of like a bell curve. You see most of the facilities are really tracking with their projections. You have some outliers that are just going way beyond their projections. You've got some people that are lagging behind. But for the most part, it's a really valuable thing. I personally wouldn't develop self-storage without getting a feasibility study to confirm the demand and see what's happening in that specific market.
Yeah, definitely. So this kind of will piggyback into the talk of development. This is a long one. I don't understand how people are building and making money. We own a property free and clear and looked into Live Oak SBA 7A at 10.5 interest rate. And between that rate and the price of development, it doesn't pencil out to build. Same with the purchase of existing facilities at 8% interest rate, where most are advertised at a 4 to 6 cap, even with 30% down, doesn't pencil out. Adam, unpack that.
Yeah, so I think a couple things there, and this is what I was talking about before, but when you say you don't know how people are building and making money, I understand that through the lens of the SBA, and that's not to say that you can't build with the SBA, but one thing to consider is that not everyone is doing 85 to 90% financing, right? So something that Anna looks at and says this one doesn't pencil. That's not every deal she looks at. They're getting construction deals done, but there are also people that are putting 40% down, and that may not be the answer people want to hear. But deals can pencil at different levels. Besides just it's not just a factor of our interest rate's too high, or something like that. There's ways to make deals pencil, but it does require, it's sort of back to that expectation shift. It requires, maybe you can't get 80% financing. Maybe you have to go out and get 60% financing to make this deal work. And it's a really good deal still. And again, that might not be, what you want to hear if you're trying to get into the space, because what the SBA is great for is, being able to get 85 to 90% financing for people. So if you don't have saved up capital, or if you don't have a ton of extra capital, it allows you to, get in and do a project. But I think there's that. And then also just unpacking the 8% rate on permanent when things are marketed at a 6 cap. I think you have to remember, it's a good point, but I think you have to also remember that your cap rate and your interest rate are very closely related, but they aren't one for one, in that depending on your leverage, your yield, your debt service coverage ratio, and the relationship between a cap rate and an interest rate vary, right? So at 60% leverage and 8% or 7.5% interest rate, you're not necessarily just in negative leverage territory, as people call it, when your interest rate is above your cap rate, because depending on the leverage, that changes things. So if you have something that's marketed at a 6 cap or a 6.25 cap, and you're able to go out and get 7.75 debt on the interest rate, that doesn't necessarily mean the deal doesn't work. It's a matter of, at what leverage does this work? So, but all those are good points. And I would not totally disagree with, I think it was Travis who said, it's hard to get things to pencil out. It is getting way harder to get things to pencil out. And another part of that answer real quick here is that some of that answer is just that there are people that aren't building and making money. Sometimes the best project is the one that you don't do. So if you're stressing your rates and you're looking at something and going, geez, this doesn't work, in that instance, it may not work. But there are still people building. We're doing more construction loans than we ever have this year. I think we've closed 11 construction loans this year, which is like, we do that many in a whole year normally. So But those are good questions. And I know that's a lot to unpack there. And I probably confused people with some of what I was saying, but I think it's important to in an expectations game as well, and kind of how the lens you view it through.
Yeah. And I've got a question for Anna and then one for Jane. And Jane, I know you want to make a point, so go ahead.
I was just going to say the circle back there to exactly what penciling means for each investor is also probably not considered, because some taking decisions 31 money in from other that are failing a little bit of return or making their return when on the sell side in 5 years is a part of their investment strategy. So, and those in a traditional perspective don't pencil, but you have to understand their priorities.
Gotcha. And then I'm going to pop this up real quick. Brian's asking, will there be a recording replay? There's always a recording replay of these events that we do on the SBOA YouTube channel. So just want to let everyone know that. And you can go back and watch our content from 3-4 years ago if it's still relevant to you. We have tons of training and educational videos out there. So here's another one from Brian. And I'll do this one for you, Anna. Because of the current lending environment, how many potential coming failures due to prior short-term loans are coming due that now don't work with the new rates?
I actually get this question, and I don't know if this is about Live Oak's portfolio. I get calls from people that say, hey, do you have any distressed assets that you want to sell? And so the answer is that we're lucky enough to not have that problem. And we've got a portfolio of hundreds of customers all across the country in every single, major market and area. And our portfolio is doing really well. And, we had to stress test it, twice in the last 3 years. When COVID happened, when it first started happening, like, oh no, what is this going to do to self-storage? Was kind of hilarious because it was amazing for self-storage and did really well. But kind of with interest rates creeping up, we kind of did a second look and kind of how our portfolio is doing. And overall, we're very, very happy with the health of our portfolio. We haven't taken a single storage facility back. And so I just kind of hope that continues. But I think that also speaks to, we've got pretty conservative kind of underwriting. At the time of underwriting, we're doing kind of stress tests. So if you're working with a lender that's financing it based on, it works best case scenario, they may have some properties that are in trouble. But I think that if you've got really prudent underwriting criteria and you also take the time to get to know your customer and lend to someone who you think is going to be a really good business operator, that's important as well.
Yeah, definitely. Anybody want to add to that, Adam?
I would love to. You knew I was going to start talking.
I can see your lips curling like he's got
I have a little. I just have, I guess, a different perspective from Anna, just because I'm a broker, so not in their existing portfolio, which I think Live Oak does do a great job of. Like Anna said, the feasibility study thing is huge. That helps them keep their portfolio on track. From where I sit, I am starting to see some distressed deals where I'm underwriting a couple of them now, and for some people, it's not a big deal. For some people, they can stay in their debt. They can sort of shore up the shortfalls they have, continue making their debt service payments. Some of them have to pay out of pocket, which is not a comfortable situation, but they say, hey, we can keep doing it for a little while. But we are seeing some deals where I'm sitting there scratching my head going, how do I make sense of this? Because this deal is, whether it was floating rate construction debt or they acquired something on a short-term note, a couple of years, 3 years, 5 years, and it worked great at 3%. And now does it work at 7.25%? So there's definitely a lot of newer product that we're seeing. So, last 10 years build, something that's been acquired in the last few years, where I'm sitting there underwriting it, trying to use every trick I have in my book to go, okay, how can we adjust expenses, make sure that we're, not having any extra fluff in here. And I'm sitting there going, geez, this doesn't cover at a 1.0. And that, that is a situation we are seeing unfortunately more and more of. I don't think it means the market's broken. I don't think it means doom and gloom again for storage. But what it means is, there is a shift in when rates are low and deals are easy, money's easy to find. And then when rates, increase as they have, some people that got in more recently, you might have to think a little more creatively, a little more strategically, bring in a partner, try and find some way to get out of an uncomfortable situation. Again, that is not the vast majority of deals we're seeing. I'm not saying that's every deal I underwrite, but I've underwritten a few in the last month where I'm going, shoot, at today's rates, I can't really refinance this person out of their existing debt. And so then it becomes a tough conversation because you have to say, hey, you might either need to take on a partner. We might need to find a way to, buy down some of your debt. In other words, contribute some money to lower your debt, because if that person's already coming out of pocket to cover debt service, that because they don't have enough interest reserve or their property's not meeting it, at surface that might sound really uncomfortable, but it might be, hey, you can save yourself this down the road if we buy down the amount of your debt a little bit, because then the deal pencils, then all of a sudden we can make it work. Or alternatively, for some people the answer is, hey, just keep doing what you're doing. You're not in a dire situation. I know you'd like to get into a lower interest rate, product, or you'd like to pull some cash out or whatever you'd like to do. But, we're certainly seeing some of that, but again, it's not the majority of the deals we're underwriting, but seeing more of it than we have since I've been doing this for the last 9 years. So.
Yeah, definitely. And I can't get to the question to pop it on screen. Maybe Iris can, because I'm still learning how to use my new MacBook, y'all. Anyone that goes from a traditional computer to a MacBook, do your research. That's all I'm gonna say, because I thought it was shiny and cool, which it is, but my goodness, this thing is hard to maneuver sometimes. But someone was asking, and Jane, this one's for you. It was based around with what's going on in the environment, should people be working with a broker? Should they be out there trying to source their own deals? I mean, you're a broker. There it is. Well, that's the response from Mike Keogh, which I do agree. Using brokers in this environment makes sense. They've got the relationships, right? But Jane, take your broker hat off for a second and put your owner hat on. Would you work with a broker?
Oh, absolutely. I would work with a broker that is not necessarily someone that I've known for the last 50 years. Absolutely not. I would work with a broker who understands my asset class and is in it day in and day out. Mm-hmm. That is truly who I would work with. I would work with them from several, because we're getting from an owner side, because fortunately I am an owner too. So I get all of the little goody stuff in my mailbox and my text messages. And so the investors out there who are hitting you up, especially on those smaller facilities, writing you those little love letters, I call them, just keep in mind from an owner perspective, even though they're trying to bond with you and be your best friend, they're really looking to pay as little as they can for it. And so when you actually push your property out there in an open market, you're going to get the highest and best. And from the buy side, that is going to truly depend if you are a seasoned investor or not, in my opinion. There are folks who's been underwriting properties and aren't brokers, and they know what kind of deals and what kind of returns that they're looking for. So we see a lot of that in today's market. They have, most groups have their entire underwriting team, so whether or not they have a broker or not I don't think is vital. If you are new to the industry, oh dear Lord, please stop and work with someone who understands what the product is, and not just what you've read about and how great it is and how it's recession proof and all of that. Work with someone who truly understands that can help you in understanding how to stress test it and just different things that happens throughout the cycles.
Yeah, and I would echo, when the Storage Pros management team started, 20 some odd years ago, we hired a consultant. That's how we started. We went to as much training as we possibly could, all the educational events through SSA, the different state level SSAs, and hired that consultant and really had them, take us through the process. But look at how that snowballed for us. Then they became seasoned investors. They had a seasoned group of investors that wanted to invest with them. They grew a portfolio to 150 locations across 8 states. I mean, they did their magic, right? But that you have to start somewhere. And yes, if you're new, please work with somebody that has been doing this for a while. We only have about 5 minutes left, or a little less than 5 minutes left. So I'm going to shoot this last question over, and then we're going to go through some closing comments and some updates for some upcoming events for you. But this one probably is the most relevant out of the last ones I have left. Are lenders now more closely evaluating the credit worthiness of that self-storage borrower, and how has that shifted maybe from 18 months ago? Anna, I'll start with you.
Yeah. So I think, so for us, I think it hasn't changed because we had good underwriting guidelines to begin with. So I think it's not, is it changing? It's just getting harder to kind of hit those metrics or those hurdles that we look for. We always want to find a facility that's going to be a good investment for our buyer, and we want to find a buyer that's going to be a good business owner. I would say one thing that's really important right now is kind of looking at, there are a lot of people flooding into the industry, which is great. There's a lot of interest, but I'm seeing a lot of people biting off more than they can chew. And so for something that I'm kind of more focused on is contingent liabilities. I was looking at a deal the other day where someone who has no experience in storage whatsoever, but is trying to get financing for 3 separate large construction projects and doesn't really have the personal balance sheet to back that up. So I think that's something to be really mindful of, is kind of figuring out what is the best first step and not trying to take on too much at once. That's really important to me. But in terms of like debt service coverage and what we're looking for, that hasn't changed. It's just what's changed is how are we going to get there, because the interest rates have moved so much in the last 18 months.
Mm-hmm.
But I do think in general, other lenders are kind of freaking out right now. And I say that just because, and I'm sure Adam can speak to this as well, I've never gotten so many emails from mortgage brokers trying to place debt. I can tell the banks of record that they've used to working with are just saying, I've been, and I'm getting so many like really solid deals, like strong deals, strong guarantors that have kind of been left at the altar at the 11th hour by a bank who kind of promised one thing but really couldn't deliver. So I think working with someone, and Adam can help you find, the right lender that can really deliver. Like if they're giving you a term sheet, they can deliver on it, versus promise you a lot of things or waste a lot of your time when you're under, due diligence, and then not be able to execute. That's a big thing. So certainty of execution, I think, is something that's really important, that I would say was not as big of an issue back when, interest rates were super low. Banks seem to be really aggressive. They're definitely, I would say in general, it seemed to be pulling back.
Tightening, yeah. Real quick, Jess, I know we're running out of time, but I would agree. A lot of the lenders we're seeing, they're tightening. They're saying, like I mentioned before, you have to have deposits now, and leverage is down, interest rates are up, so they're stressing with higher interest rates. They're more focused on what is the net worth and liquidity of the sponsor, and some of those metrics are notching up. So in addition to needing deposits, you also have to have really strong balance sheet as a borrower, which makes sense anyway, but some of that has tightened because things are getting more difficult. And then one other quick point is the tough love thing from a lender. Sometimes it in the moment doesn't feel great, but to Anna's point, I mean, if they're giving you tough love because they're trying to find a way to put a term sheet in front of you that they feel they can get done. If someone gives you this pie in the sky term sheet, you're going, oh, well, this person, said they can do this loan at this level. And then you have someone over here who you feel like spent more time with the deal. They're more conservative. Well, guess what? Lender A could very easily retrade you in 60 days and actually below lender B, because they're getting a slap on the wrist from their credit team going, this is too aggressive. We can't do this. So sometimes that tough love, and that's one of the things, Live Oak, there are certain things in place so that they know that 3 years down the road, when rates have increased as much as they have, they're not looking at a portfolio and a portfolio of loans that's all underwater. So, the tough love from lenders, it's hard to walk my borrowers through that sometimes, but then those end up being the best executions, because it's like from where we started to where we close is the most similar. So that's one last point.
And as we're vetting buyers and looking at offers, that's what Anna and Adam are saying are huge deals, because we're looking to see who can get across the finish line. And we're looking to see if you have put other properties under contract and those fell through and why. So having your ducks in a row with a good banker is important.
Yeah, absolutely. Well, sadly, we have run out of time. I know this is a hot topic. We could probably keep going on and on. A couple quick announcements. If you are in the state of Arkansas, I will be there next week. It's the Arkansas show. If you happen to be there, please stop by our booth and say hello. Not sure if anyone else here on the call will be there, but I know the SBOA will be there. And then we've got the big national SSA fall show coming up the first week of September in Vegas. My team will be there. Adam, Anna, Jane, tell us if y'all are going to be there and where we can find you.
We're actually, Sauls Storage Group will not be in Vegas, but we will be hitting all the local. I know, right? We're taking a hard pass on that. As a new grandma, I'm staying a little bit closer to the house.
I don't believe you. Yes. And then Adam's a new dad, so he might be saying the same thing you just said, Jane.
I am going to Vegas, but I will be in and out. I will be in and out pretty quick. And I didn't do the one piece of homework I was supposed to do. I can't remember what our booth is, but you'll hear Sean. If you know Sean Hill, you'll hear him from like 6 or 7 rows away, and you'll know that that's where we are. But yeah, we'll see everybody in Vegas if anybody's coming. And yeah, so.
Sean is so animated. Everybody loves Sean.
Yeah, he is.
Anna, how about you guys?
Yes, I will be there. All the self-storage lenders will be there. We're looking forward to it. We are at booth 355. So come by and talk with us. I'd love to meet anybody that's on this call.
Yeah. And for those of you on the call that don't know about the national event, you can go to selfstorage.org. That is the national website. You can go under upcoming events. It'll be blasted all over that website. Again, it's the first week of September in Vegas. All of, the leading companies will be out there. Please stop by the exhibit hall and visit with people. Don't avoid vendors' booths. They're there to talk to you and help you and give you products and services that you need. Don't just grab the tchotchkes and walk away. Spend some time, network, get to know your vendors. We are a critical part of the puzzle too, just like the lenders and brokers are. Same goes for the vendors. Lots of educational events. I'm teaching one on Wednesday morning about internal audits. And helping operations. But please check that their website out. You can go to the exhibit hall and find the booth numbers there. And I believe their pre-registration rate ends this Friday. So if you want to get in at a lower rate than paying a higher ticket price, check that website out before tomorrow. Because I think that deal ends tomorrow, and then the rate just steadily increases from there, especially if you buy tickets on site. But you are able to walk in the morning of and buy a ticket if you decide last minute you want to come hang out with the cool kids in Vegas for a week full of self-storage education, networking, and all kinds of fun events. They do a really great job. So thank you everyone for being here today. Pleasure seeing all of you. Look forward to seeing you all in the next couple weeks. With the exception of you, Jane, I'm super sad about that, but I'm sure I'll see you at the Georgia, South Carolina event. That is in October. If you need information on state-specific events, contact the SBOA. We know about all of them. Or just go to your local state association's website. It should have it on there, but most of them have some level of an educational event and trade show in the fall. Fall schedule is very busy for us. So we hope to see everyone out there. Stay tuned real quick for a quick video. Oh, one final announcement I almost forgot. Next Thursday, if you are a newer owner or operator in the space, or you're looking to grow your portfolio, Storage for Rookies, which is produced by my team at the SBOA, is a training series, a one-day virtual online, it's, I believe, from 11 to 4:30 next Thursday, August 24th. Please sign up for that. It's a low ticket. I think the ticket's $49 for a day of education, where we can really walk you through the stepping stones of how to get into this industry the right way, because we did it. We were successful with it. So that is next Thursday. Stay tuned for this commercial. Thanks to everyone for being here. If you want to watch any of the replays of any of our webinars, visit the SBOA YouTube channel, smash that like button, smash that follow button. There's a lot of good information out there for you. So I hope everyone has a great rest of the Thursday and a great weekend. Bye, everyone.
Yes. Bye, Jane. Bye, Anna. Thank you.
Thank you for calling self-storage. This is how may I help you?
Yeah. And do you guys have any storage available, places, spots available?
You said you're looking for a parking space?
No, I need some storage. I'm moving to town, and I need to put my house in there, or my apartment, I guess I should say.
Okay, absolutely. Are you looking for an air-conditioned unit or a non-climate?
I think non-climate. I don't think anything in there is probably that, sensitive.
All right, and so with that, our non-climate units with the drive-up access, we have the largest being 10 by 35s, and then down from that we have 10 by 30s, 10 by 20s, and 10 by 15.
Yeah, maybe a 10 by 15. I mean, it's actually a 10 by 20.
A 10 by 20? All right, and those are starting at $269 base.
Okay, thank you very much.
You're welcome. Have a great day.
You too. Bye.
All right, everyone, that is our new product line. If you want to have your facilities mystery shop to see how well your team is performing, get in touch with us. We'd be happy to run a few of those for free so you can test our software and get a demo of that product and service line that we're offering. As you can see by that video, that is actually one of our clients, and that was supposed to be one of their A+ employees, which if you can unpack that call, a lot of things did not happen that should happen in that call. We also have internal audit software that you can use through a smart device. It has talk to text where you can walk your facility and take those internal audit measures that you have set up to make sure your property is still in good shape, and performance measures and metrics and all of that are happening. If you want more information, email info@thesboa.com. We would be happy to talk to you about that. Again, thanks for joining us for another episode of Self Storage Unlocked. We'll be back next week for rookies, storage for rookies. And I think the week after that, it's the week after that, we have another Self-Storage Unlock coming to you. If you want to learn about any of our past events, again, go to YouTube. Any of our upcoming events, go to the SBOA.com/upcoming events, and you can find out all of the different things that we have coming down the pipeline for you. Have a good day, everyone. Take care.